everybody, listeners, welcome to episode 1, season 1. Season 1 is going to be called Real Estate of the Capital Contribution Live. Today on the show, we have Matt.schofield. Matt.schofield is with NJ Lenders Corp, and Matt is a mortgage loan officer. I am Yuri Kapilovich, owner and operator of Kapilovich and Associates, CPA. Been doing this stuff for 12 years, working with some of the largest firms in the country, on some of the largest tax returns in the country. And what I learned by working on people making $80 to $100 million a year is that I learned all the high level stuff. I learned all this crazy big money stuff, but never really was able to take it down to my own tax return in my own world. And, and dealing with the smaller level, the clients, the folks, the everyday folks, really, you kind of get caught up in that big money world. So when I was purchasing my first house with Matt himself, I thought to myself, well, this is a stressful situation. But I thought, all right, well, I'll be prepared when I'm going to buy my second house. Now, just recently, 2 months ago in July, you helped me also buy my next house.
Correct.
And I sold my old house. And I thought I was going to be ready, man. I thought I was like, man, I bought my first house. Like, hell yeah. It was amazing. And I'm so ready. And that was so easy. That was actually a fairly smooth process, but you still were able to pull some tricks, man. Like with that door that was broken off and you helped me out with that. And we were able to close. And just so many things that from my experience, I just nod in my head, when the attorneys tell me, attorney review. Yeah.
Yep.
Mortgage commitment. Yeah. I know that. Yeah. But but really I didn't know what the fuck they were talking about.
And it's crazy. It's like no matter how many houses you buy or how many refinances you do, the process seems different every time. The situation, it's never identical. There's always something new. And that's what makes sometimes the mortgage industry a little challenging for the average folk or the client, because they're just not used to that.
Yeah. And the biggest thing that happened with me is, you have a lot of pulls and pushes right in there. You got the other side, the seller, who just wants to close. We were nice sellers to our buyers. So I'm a little biased, but we were.
Yes.
We weren't pushy or anything.
Yes.
You then have the seller of your future house who might not be so nice and so accommodating.
Yes.
So that's a push. Then you got the attorney who's pushing on you to get all the documents that they need.
Multiple attorneys.
Multiple attorneys from both sides. Then they're naming all these things: mortgage commitment date, attorney review,
closing date,
clear to close, inspection dates. You're just running around like a crazy person just trying to get all that stuff, but you don't know the basics.
Correct.
And that is why you're here.
Yes.
So kick it off, man. Tell us about yourself. What do you do? The background, and just let the listeners know.
Yeah. So basically, my name is Matt.schofield. I'm with NJ Lenders. We're a correspondent lender. So what that means is we lend out our own money. We do the in-house underwriting. We do everything from start to finish. We're kind of like a bank like Wells Fargo. The difference is we just don't hold deposits. We just strictly deal with mortgages. I've been a loan officer for about 8 years now. I've been in the industry for over 20 plus.
Wow.
Literally went through every single department in the industry.
That's awesome.
All the way from the mailroom to where I am now.
Wow.
Every aspect of the operation side. And I kind of did that because I just wanted to know the industry inside and out before I got into, because the sales side, it's a different animal than the processing side, or the operation side. You're dealing with the client, hands-on, you're helping the client. And I just felt like to have a stressful thing of buying and refinancing a house, trying to help curb that a little bit for them to have all the answers and questions that they need. And basically, when I went into sales and became a loan officer, I had a lot of confidence going in there to be able to do that for the client. And that's basically what I do. I basically handle the loan process for them. I am the front person, let's call it, with the mortgage company. And just take care of the process and work with them directly from start to finish.
Yeah, that's exactly what I experienced. You were able to hold hold my hand through the process, help me out. You were telling me everything as I was going along, which was tremendously helpful to me, which is also why I wanted to have you on the show, just because we're the main kind of glue in the transaction.
Correct.
To keep it all together. And I think you're doing that on a lot of transactions. I don't really know how you're doing that.
Yeah.
You're multiplying yourself or something to like.
And it's good to hear you say that too, because a lot of people don't look at the mortgage person as the person that's like kind of centered. You know what I mean? We are dealing with the client. We are dealing with the realtor. We are dealing with the attorney. We are dealing with the title company. We are dealing with our in-house people to make sure things are moving along. And it actually is nice to hear that.
Yeah, and I mean it's very true because I feel it. I feel that the realtors, they help you. They help you out to get you the house, right? And they connect you with a mortgage person, and then you go, okay, now they're kind of out of the picture, right? Because they're on to the next client to try to find them. They're in it
in a sense.
In the sense, they're in it to guide you along, and that's how I felt with my transaction. They were there to guide me along.
Yeah,
they were there to help me out if I had questions. But most of my questions past a certain point,
correct,
were to you.
Yeah, and that's part of the process. The realtor is doing all right, let's go look at houses.
Exactly.
Let's find in your situation a buyer to buy your house, and we're going to find a house for you to buy.
Exactly.
So they're doing a lot of that work up front. And once they get to a point where it's like, okay, we have the house, we have an accepted offer,
right,
the realtor has to look to the loan officer, you know, and it's really up to the loan officer to keep the realtor up to date, and that's where good loan officers separate themselves from average.
Absolutely.
Is because they're able to keep that person, the realtor, he or she, in the loop so she can continue to go and try and get the other clients that are new coming in the door, helping them find a place. And it's hard for them to have a situation where things are, let's just say, not going as smooth. I wouldn't say fall apart, but not going as smooth, and they're not getting the answers, and they're constantly trying to get a hold of the mortgage person. Meanwhile, they're trying to take, so their job is just as stressful as everyone else's, And,
absolutely. And the attorney, of course, as well.
Yes.
So tell the listeners just, if they're curious, what is the process of becoming a mortgage loan officer, since you went through kind of all those steps, mailroom up, working your way up, and how does one person become, how does somebody become a mortgage loan officer?
So basically, it's actually pretty easy, believe it or not. You don't have to have college education. You don't have to take certain steps that people that make good money in bigger positions have to go through. It's actually pretty simple. You decide that you want to do it, and you go do the licensing hours and the test. And majority of the stuff you could do online. And then when you have to go take the initial state test and federal test, you go somewhere and take that test at a facility.
Okay.
Once you pass it in that type of setting, then every year you just do your renewals online. So it's actually pretty easy for a person to actually get licensed as a mortgage loan officer.
Okay. Yeah. And then that's the thing to me too. It's easy to get licensed, right? But then you start dealing with people's largest purchase, largest transactions in many people's lives.
Correct.
And that part, again, I'm sure there's a course to it that you got to go through, obviously, and get all your information, get all your knowledge. But then to actually apply that knowledge, and to understand, one of the things that you do best, from my viewpoint, is you were able to, right from the start, even if you're super busy. I remember, you would get this Excel document together, showing me the 3, 4, 5 options that I could have based on a purchase price, my down payment, and the loan amount. So let's take it just a step ahead of time a little bit, and to kind of think about the whole process. So, and correct, you can jump in if you're thinking I'm off in the wrong direction. But as somebody who's starting to look for a house, first step in my mind is finding the house is important. Yes, the right price and all of that, and what you love is important. But I need to know the numbers. Yeah. As a CPA, it's inherent to me to know the numbers. But I want to know, before I even jump in, what can I afford?
Yes.
And that is, so the first step in April.
That is the first step.
That is the first step.
Yeah, you have to talk to the mortgage person.
And I've seen it before, and I've heard it before, just from many people. that they just go to the house.
Yeah.
Now they love the house. Now what?
Yeah.
So tell me the basics. Walk me through the basics of the buyer. Like you said, mortgage is the first step. But they're like, I want a house. What do I do?
Yeah. So and that the very good point is a lot of people don't know that first step. A lot of people think go to the realtor, find the house, and then get the mortgage, right? And that's not the right step in my opinion, is because, like you said, you don't want to go look at the house and fall in love with it, and then you realize after you can't afford it.
Yep.
And then you just completely already getting a sour taste in your mouth in the first step. So really the first step is to, and you could do these steps together. You can interview realtors, and you want to talk to a mortgage person. That mortgage person will walk you through the initial step, go over your financials, get the documentation needed to do the pre-approval, and put those numbers together for you. And they actually, what I do personally is I have the conversation. And I don't know if you remember the first time when we talked, some of the questions weren't just about, okay, what do you want to do with your mortgage? It was more, how long you see yourself in this property? Is it your first house? Is this the area that you see long term? And then we put the numbers together, and what kind of down payment do you have? And then it's also looking at, like when we spoke in the beginning, was we were looking at a finished house and a house that you had to put money in. So getting all that documentation and all that information and getting the approval up front for the client, that is really one of the most important up front, because it actually tells you where you need to be and feel comfortable with that payment and look in the right purchase price range.
Absolutely. And I think what's another important thing to mention is as you're looking at the houses and you're going around, if you didn't have the pre-approval, what's the first thing they're going to say? Okay, submit an offer.
Yeah.
And you're going, uh-oh.
Yeah.
How am I going to, what do I need to do now? Oh, you need a pre-approval.
Yes.
And you could potentially lose the house of your dreams or the house you really wanted because someone else might already have the pre-approval.
Yes.
Someone else is already ready with that. All they need to do is draft up that offer letter and get it accepted. And I mean, that part is extremely emotion-filled. The part where you're submitting an offer, you're getting nervous, you don't know if it's going to get accepted. And the worst thing you could do is when you go to say, yeah, I want an offer, I love this house. And they go, okay, great, let me see your pre-approval letter. And you're going to what?
Yeah.
So I want to talk about the pre-approval letter. So this is kind of like the first step once you've already spoken. So, you said you go over the finances, you look at the W-2s. I remember you looked at mine. And we'll jump into some of the different criteria with that in mind. But from the basics standpoint, when you say you look at the financials of someone, what are you looking at exactly? Kind of what are you gauging? And obviously the money in the bank as well. But just kind of walk me through that process of the pre-approval.
So we're looking at everything. I mean, it's not just the financials. We're also looking at their income. We're also looking at their credit. We're looking at their history, their job history. And that's basically the pre-approval process. You're looking at the whole credit history and income profile and financial profile while you're doing that pre-approval. Right.
And then you're looking at that. And I remember, and at least from my experience, I know that certain lenders spend more time on the front end. And again, I keep shouting you out on this one. But the reason why, again, I liked working with you is that you are very thorough on that pre-approval step.
Correct.
And I think, at least, a lot of folks don't spend as much time, don't get as into what you can afford, what you cannot afford, and don't really get into the real numbers of the dynamic, right? Because they just want to get you that letter and they'll deal with it later.
Correct.
Because the steps are the pre-approval is there, then you can submit your offer.
Correct.
The offer gets accepted, the attorney review is over, you go on the contract, you begin, and you begin the whole process of getting the mortgage together.
Mortgage commitment, yes.
Mortgage commitment and mortgage fully approved. Now, so that's the step. But so what do people mean when they say, or when people would say, okay, I'll just give you a pre-approval letter. Yeah, you're good for that $600,000 of mortgage. We'll deal with it later what kind of issues can come about by doing that?
By just giving a pre-approval letter and not
Yeah.
looking at all that?
Yep.
Many issues.
Yeah.
Yeah,
So
I
walk
mean,
us through them.
not enough income,
Yeah.
not enough assets, bad credit history.
Right.
There's a lot. There's a lot there. And you know, there's questions that you could ask up front that actually help both the client and myself out.
Right.
Predetermining that before anything comes an issue.
Right.
You know, and that might be something as simple as a blemish on their credit that they never knew was there.
Right.
Right. And then I could help them say, all right, well, here's what we could do. Here's some numbers, but no, we have to do this
Right.
before you submit an offer. And that way it could be something that we could catch before they're out there trying to get a house and then coming back to me and say, all right, I got a house.
Yeah.
And then I pull their credit and that issue comes up. Then
Yeah.
it's too late. And then they have to go back and everyone's stressed out.
Exactly.
You know, things like that. So there's a lot of things that in the beginning come up that can be addressed to avoid
Right.
hassles for you in that beginning process.
Yeah, and you can certainly also send out that pre-approval letter so they can, make, as long as they're aware of all these potential issues that will come about, and they start the process of addressing those things as they come up. Because again, as you said, it's a very stressful process, and when it's exacerbated by things found in the 11th hour on,
That's
things,
the hardest
that's
part.
the hardest part because you left it to go. You got a letter saying you're pre-approved for a $1 million loan, but really you can barely qualify for a $300,000
Yeah.
loan. And now you're getting everybody upset in the
Yeah.
process. You know,
Yeah.
the realtor is going to lose their relationship with the other realtor if they submitted the offer and got it accepted. The, attorneys are going to obviously also be unhappy because they're going to have to explain that it didn't work out. And sometimes these things can only be discovered, right, so late, right? I mean, you could have already gone through attorney review.
Yes.
And the potential issue is once you've gone through attorney review or on the contract, now there might be some penalties as well.
Correct.
So what I want to kind of summarize this part of the discussion with is when you are ready to buy a home and you're excited, you think it's the time that you want to start looking. First step, get in touch with a mortgage loan officer, get all of the financial side of things, the potential pitfalls
Correct.
in the journey, get them all on the front end.
Yes.
So you can find out. But listen, most people don't even have a track on their credit score.
Correct.
Most people don't even know what their credit score is.
Correct.
Well, let Matt or whoever you're working with run your credit.
Correct.
Figure out, okay, well, dude, you got a 700 or 650 credit score. What happened? Really? Now you're starting to call up credit agencies. Now, and you're doing all that on the front end. And just imagine, and I can just imagine having gone through it 2 months ago, I could just imagine doing that not on the front end, but doing that on the back end, like as you're about to close or whatever it is, a month before you're on, and now you find out you have all these things you got to iron out.
Yeah.
And that is just awful.
Correct.
So-
It is. It's hard on everyone,
Yeah.
and it's really hard on the client too because they get really stressed out.
Yeah.
So yeah,
And-
it's important. That first step is big.
It is.
It'll smooth the process from start to finish if you do the right step first.
It is. And that's the important part. And again, you're discovering the potential pitfalls and preventing yourself and the client mostly, as the client, you're preventing yourself from being super stressed out down the line.
Correct.
So that'll be kind of like step one. And let's talk about kind of the next step typically, which is, so you have the preliminary set of documents that I know you usually kind of ask.
Correct.
W-2, whatever. So we're going to talk about just your W-2, husband and wife working together, working, on a W-2 job, whatever that is. Once you get past the pre-approval step, and we found the house of our dreams, and you now are going to start the mortgage commitment process. What documents, I know that there's a big list typically you would ask, but what determines from your side what documents you need from the client?
Okay. So it's pretty simple. Like you said, if it's a W-2 employee,
Right.
pay stubs, W-2s, bank statements, simple things. If they are self-employed, you have to get 2 years tax returns, have a 2-year history of self-employment.
That was my problem.
Yep. and so it does determine on, what the employment is for that client. But it's usually the basics. And again, that part of it can be addressed up front during the pre-approval process. So again, that's why the pre-approval process is very important because it just makes each step go that much smoother.
Absolutely.
And like if you remember, it's a lot of paper pushing back and forth as you're going through the process.
Oh, yeah.
So you try and knock out all of it up front. But yes, if you're self-employed, you need 2 years tax returns. Bank statements are very simple. It's just 2 months bank statements.
Right.
If you have to use 401k assets for reserves and things like that, those are usually quarterly statements. So it's the normal documentation of IDs, pay stubs, W-2s, bank statements, tax returns, things like that.
Awesome. So I'm just going to pause here for a second, and we're going to, just going to dive a little bit. So what Matt has just said, and what you're referring to here, on the pre-approval side of things, you're going to request W tax returns, bank statements, 2 months worth, any other assets if you need to use them. But this is the time when a mortgage loan officer like Matt would be going through that to determine what possibly else does
Correct.
a person need. What can you qualify for? What mortgage can you even have? First of all, many people might not even know exactly how it works. Down payment, what is that? So if the purchase price of the house is $400,000, do you even have, usually it's 20%, that's 80,000. Do you even have $80,000 in your bank account to put that down to then, make the mortgage amount $320,000?
Correct.
And what is that payment going to be on a monthly basis? So you're trying to take all of that into consideration, give the client what their monthly payment is going to be. And all of that is based on all these documents that we're talking about
Correct.
here. So the bank statement helps Matt, you, whoever, determine how much liquid or usable cash you truly have in your bank account. Step one. Can you even give $80,000 to this mortgage, towards this house without having nothing left in your bank account? That's bad. We don't want to do that.
No.
So things like that. And if that was to be determined, that's what the pre-approval process is so important, as you're saying, is if that's important, then you got to say, okay, well, let's think of another option. Maybe you go on an FHA. What does that say? Federal Housing Authority, right? FHA, which allows you to put down less than, if you're a first-time home buyer, right? You can put down less than 20%.
Yes. Conventional allows you to put less down too.
Yeah, and conventional as well, but you're
Yeah.
going to have the PMI or what is it?
Private
Primary-
mortgage insurance.
Private mortgage insurance,
Yeah.
which adds on to your monthly payments.
Correct.
But those are all the options, and there's no harm necessarily. You can always refinance out of private mortgage insurance or
Yep.
PMI
As you're building equity.
as you build in equity. But these are things that many folks don't know about, but that's the part of the process of the preliminary kind of first step pre-approval process.
Correct.
You would tell them, okay, you have $50,000 in your bank account. If you really love this house, you maybe can put down 3% and try to figure out various programs that you might qualify for. But regardless of that, if you love the house, here is your payment.
And that's like you mentioned in the beginning where I utilize those spreadsheets.
Yeah.
It's huge.
It's huge.
Because even if you have the 80,000 to put down,
Right.
you do have the options nowadays to put a lot less down
Right.
on a purchase of 400,000. You can go as little as 5%, sometimes 3% down.
Yeah.
Right. And that is where that spreadsheet and that initial conversation is so important for the client and the loan officer, because
Absolutely.
we could have that conversation and say, hey, you know what? You don't have to put all that money down. It's not going to make a huge dent in your payment, and you may feel a little bit more secure having that reserve in there.
Right.
Or like, for instance, right now, I just had a client that she was single. She's buying her first house.
Right.
And she had X amount of money to put down.
Right.
And I looked at her situation financially and actually redid the down payment and
Nice.
used a portion of that money to pay off debt to make her more comfortable financially
Right.
to have that house payment.
That's actually incredible. And again, this is why you have this in-depth pre-approval conversation, because you can discover all liabilities in there, which any liability would potentially even hurt you in the mortgage process, because, and we'll get into that, the debt to income ratios, the things that drive your rate, the things that drive your applicability or qualification for the loan. But that is very important, and it's important to manage your money well. maybe somebody out there who is not as thorough might say, "Oh, great, you have $100,000. Put 80,000 into that down payment. You'll have 20,000 left. Yeah, okay, whatever. You still have debt.
Yeah.
But you got to look at the full picture.
Correct.
Because again, you might be able to qualify for a home with 3% down. And as a matter of fact, to those listening to, that's what we did on my first home purchase. It was a foreclosure. It was, and I put down, I think I
Needed
put down
a lot of work.
Yeah, I did a lot of work. So I needed to save all my cash.
Yeah.
So it was a $300,000 purchase.
Yeah.
But, on the home value. So on the 20%, it would have been $60,000 that I would have had to put down if I put down 20%. But I put down 3%.
Yeah.
And I think all in all, my total closing costs were for everything, including the down payment, was like 18 grand.
Yes.
So I was able to, even though I had
I think
the
we
cash,
even did a credit
yes,
for the closing costs.
You did.
To keep as much as that cash in there.
That's right. Because you knew, and this is a phenomenal example, you knew what I had to do to that house.
Mm-hmm.
I needed like 80 grand of work.
Yeah. Yeah.
And so you knew that I needed to put a shit ton of money into this house, which means I need to keep as much of my money to myself in my bank account and, figure out the kind of mortgage payments, after that.
Correct.
But what happened was, and you immediately told me that, I remember this to this day. You said, look, you're going to put down the 18 grand with everything out of pocket. You're going to you're going to, build equity in your house by doing the renovations and making the value of your house go up.
Correct.
And that's exactly what happened.
Yeah.
We did the renovations. The house was now worth 400 grand. And now I was able to refinance. And because I did those renovations and the house value went up, I automatically almost got that 20% built-in equity.
Correct.
In the
You
house.
did. You did, because we got rid of the PMI.
And we got rid of the PMI. So I had PMI for I think it was 8 months. We
Yeah.
bought the house in February. I did a renovation. In October, we refinanced.
Yeah.
So all these conversations that we were having those on the pre-approval side.
Yeah.
We weren't saying, oh my God, what are we going to do? You knew what I was going to do.
Yeah.
And that is exactly what we're talking about here.
Yeah.
That is the beauty and the power of having someone who's around it, who's thinking of all the sides of things, not just getting you to the closing table and not just getting you the best rate. And the
Correct.
best rate is important too. So walk us through now on the rate side of things, how, obviously you have access with NJ Lenders Corp, you have access to, check out a bunch of banks.
Mm-hmm.
So what is the advantage of going through an NJ Lenders Corp, or, what did you call it again? What was it called?
We're called a direct lender.
Direct lender.
Yeah.
Yes. Okay. So what's going through a direct lender rather than going to like PNC Bank?
Okay. So really the difference is we could shop multiple rates, right? And banks are a lot like, let's say, an insurance industry, right? When banks get flooded with volume, they tend to raise their rates to slow down the volume, just like how insurance does. When they have too many people insured, they inflate their premiums.
Right.
So people wind up shopping elsewhere and going and get it elsewhere.
Interesting.
So if you went to PNC in that situation,
Yeah.
then you're only getting what PNC is going to offer.
Right.
Where with us, I might be able to say, all right, well, what are we offering? We have Wells Fargo, PNC, Chase, Nation Star, a handful of banks that we can sell your loan to. Okay. So now what we're doing is we're getting a whole gamut of options and rates. And that's where that comes in, is where it's a little bit sometimes more favorable than PNC. And on top of that, not only the rates, but also, it's hard to say this, but PNC is like a PNC or Wells, their guidelines are set and you have to meet them, and that's it. You know, where we might be able to say, all right, you know what, this is a gray area. Fannie Mae says we could do it, so we're okay. We could approve it. Where PNC says Fannie Mae could do it, but we have our guidelines that we want to stay. So that's the combination of it, you know. But for the most part, banks are really offering the same rates.
Yeah, absolutely. And I think, and that's with our situation, again, you were always able to present, 1, 2, 3, 4, 5, 6 options. Mm-hmm. These are all different banks. These are all different rates. Here's how it's going to impact your monthly payment. And really, to me, even with this market, and I know there's a lot of talks in there with the rates, and I think the Fed rate is about to go up or
yeah, they raised it again.
They raised it again. and it's scary, and it's freaking people out, and
It
rightfully
is.
so. It's a very nerve-wracking experience, and this is again the goal of what I want to do here, which is to ease people into the process to understand what all of that means. At the end of the day, you got to look at the bottom line of your monthly payment.
Correct.
I don't care, because listen, remember, rates used to be 15%, rates used to be 20%. But at the end of the day, you got to look at what is your monthly payment.
Correct.
And can you afford it given your circumstance, given your and whatever options that you might work. Maybe you put down the least amount. And what is that going to be from a monthly payment? Put down the most amount. Empty out your bank account. I'm not saying do that, but if you were to do that, what would that mean for your monthly rate? And that is the primary most important thing, because if you can afford the payment, even with 25% interest rate, you can afford the payment.
Yes.
You can refinance down the road.
Yeah.
So these are the conversations. This is what a mortgage loan officer does. And it's extremely helpful because it guides you through the process, because you can understand, okay, I'm making $8,000 a month, and right now I'm paying, sometimes people are paying rent, $3,000. And now Matt comes in and for the house of your dreams, you could be paying the same $3,000 a month.
Sometimes a lot of times less.
Sometimes even less, which is incredible. People don't think about that.
No.
But as you're going through this process, you're saying, oh my God, if I can afford a $3,000 a month rent, I can afford a $3,000 a month mortgage. But you got to know the numbers.
Yeah.
And as long as you know the numbers and you're comfortable with them, then you can make the next decision of
Correct.
Where do I stand on my purchase price.
And that's a pretty big point, is payment. Because like I tell a lot of people, you may be able to qualify for this house, and you may be able to afford the payment, but it just may not be something that you want to pay right now. Right. So you may reduce your purchase price because you feel a little bit more comfortable paying this, even though you can afford this. You feel more comfortable here, and that's a big thing to know.
Yeah, no, absolutely. I mean, that number is one of the most important numbers that you can have. And let's talk about it a little further. In some situations, you can escrow the taxes.
Correct.
So this is something to keep in mind as well. Escrow means that your tax payment, your property tax payment on your house, is kind of lumped into your monthly mortgage payment. You're not required to do that, right?
If you put less than 20% down, the banks do require it.
Ah, interesting.
Yes.
Okay.
So you have to put 20% or more in order to have that option.
Okay. So let's just say you put 20% or more. You have the option now. That's a great point. I didn't know that. To pay it quarterly, right? So the reason this is a good consideration is you want to make sure that when you're talking to a mortgage loan officer, you're saying, does this payment include my property taxes? Which, I mean, I easily saw it in your spreadsheet. But again, because if it does not, and you're saying, I can afford this. This is awesome. But tricked, not tricked necessarily, but a little curveball.
And that could be a pretty hefty payment sometimes.
Could be, listen, if the payment, so if the quarterly taxes are $2,500 a quarter, that's $10,000 for the year in property taxes. In our area, that is not rare.
No.
Now you're talking about a $4,000 a month payment, let's say, without property taxes built in. So you're going along and saying, wow, this is great. 4,000. Yeah, 4,000. April comes along, first quarter. Hey, pay up $2,500. You're like, wait, what? I thought that wasn't part of my payment.
Yeah.
And that is not something you want to discover.
Yeah.
Once you've closed, moved in.
Correct.
Already spent money on renovations, and you got like $10,000 left in your account, and now you got to chop up another $2,500 for quarter. And now you're going, oh my God, wait, it's not a part of it. And then you got to now be ready for that again and again and again. So these are the kind of considerations. Another consideration is the insurance, right? Homeowners insurance. Now, is there an option to not have that be in your payment?
20%.
Ah, same thing. Okay.
Yeah.
So same consideration. If you decided or if that was not built in, and I can see, I'm not saying people are doing this, but I could see it being like a way to select one mortgage lender over another, maybe. If in that initial consult or whatever it is, or initial conversation about the pre-approval, they might say, oh, well, your payment is less. You're attracted by this lesser payment, and you're going, that mortgage officer is better than Matt.
Yeah.
He gave me a much lesser
and that happens
payment.
a lot.
Yeah, I can imagine
even
that.
with like rates, there's banks out there that will, give you a better quote on the rate,
Right.
but they don't tell you there's a fee involved for the rate. So a lot of times is, they'll add what is called as a point,
Right.
an origination point that you'll have to pay to get that rate. So for example, let's say I say, your rate's 5% and this person says, oh, I'll give you 4.5.
Yeah.
Or I won't even go that far. Let's say 4.75.
Sure.
And you're borrowing 400,000. You may have to pay $4,000 for that rate.
Wow.
And some of the banks won't disclose that. It's kind of like if you don't ask, don't tell type of thing.
Interesting. Yeah.
And it happens a lot. And if you,
Right.
as a client, don't know that, you find that out at the end lots of times.
Yeah.
Because a lot of clients, they don't look at the fine print. They
Yeah.
just sign, they trust the person, and then they go to the end and go, what's this 4,000? Where did that come from?
Yeah. And it's too late to do anything.
Yeah.
And that's why, having an honest person that brings all that stuff up front, and that's an option. And you know what? I might be willing to do that option.
Mm-hmm.
That might be a really good option for me. Hey, I'm going to put, $4,000 down so I can control my payment a little bit better on a monthly basis, lower my rate, do whatever, maybe, refinance down the line. But that's a great option. And you want to have someone who's opening up with that. And you want to understand what that means,
Correct.
prepaying and I've heard that before,
Mm-hmm.
to buy the points, if you will,
Yes.
right? So to kind of make that payment. But that's important to have all that on the front end. And
It
you
is.
do not want to find that out at closing.
No. And that's why it's important to, a lot of people get nervous when clients shop
Right.
for other loan officers.
Yeah.
I don't. I understand
Yeah.
it. You know what I mean? If you're going to go buy a car, you don't walk to the lot and drive off.
Right.
You try and go and talk to a couple places, see who's going to give you the best deal, right?
Sure.
And that part is important for the client as well, because you kind of tend to find out who is, let's just call it trustworthy, right? Because if you talk to a loan officer and he lays everything out, and I always tell my clients, listen, if you're going to shop the rate, that's
Yeah.
fine. I'm never going to hold that against you. I think it's a good thing.
Absolutely.
I only say, don't show them my spreadsheet. Get your real answer. If you
Right.
show them my spreadsheet, they're just going to look at it and say, oh, I'll do that and just a tad bit better.
Right.
So by doing something like that when you're shopping around,
That's a good idea.
you'll actually hear who's giving you realistic answers. And at that point, you could kind of determine who you're comfortable going with, and that person's going to walk you through and is looking out for your best interest.
Yeah. And that's actually a great point, because I was just going to ask you the same thing. How can someone, obviously they can go to you directly, because you're great. I work with you as well. But
Appreciate
maybe
that.
they say, well, maybe there's somebody else out there. So how would you differentiate between them? And you kind of started to allude to that. Let them do their own Excels. Maybe they don't even give you an Excel.
Yeah, a lot of
That's
people
not good. So you have somebody who's giving you an Excel, giving you all the things up front, asking you the questions. But how would I, as a brand new, never bought a house before, how would I shop and pick a mortgage loan officer?
So there's a few different ways. Obviously there's the internet that has a million people that you could choose from,
Right.
A lot of times people get referrals from friends and colleagues.
Yep.
The referral is probably the best way to go, because if you're getting experience from someone that has worked with someone already,
Yeah.
you kind of took a lot of the questioning and the concern off the table.
Right.
And then it's always good to just shop. A lot of people go into their place of where they're banking.
Right.
You bank at Wells Fargo, you could talk to someone there. And then again, of course, there's stuff all over the place,
Yeah.
internet, commercials, so, you just have to just pick up the phone and start talking to some people.
Yeah. And that's great. And I think you would get a vibe, you would get an idea of, how that person has the best interest in mind. Are they just trying to push you to close with them? Are they just trying to, are they providing you all the information? Are they giving you all the choices, all the answers? And yes, for me, I think we got connected because of you just worked with the realtor that I was working with at the
Correct.
time,
Yes.
Donna. And she recommended you. We worked together. I liked you. You were able to resolve things. You were able to As we had some bumps along the way, you were able to smooth them out very smoothly with no stress. And to me, the best part is you were pretty chill about it. So it was like, you're chill about it, I'm going to be chill about it.
Yeah.
And I think that's important too. So I think there's a lot of factors in picking someone, but that's great.
Yeah.
That's some great advice. Ask them. Don't show them a spreadsheet. Don't show them the other stuff that someone else gave you. Kind of let them do their own thing and see what they provide you with.
Correct.
So that's that's really good as
and
well.
you'll know when you're speaking to someone. You know what I mean? If you remember the amount of questions I asked you, it wasn't oh, all right, you want a 30-year mortgage, you want to buy this, all right, here's your numbers. There was more questions, like how long you see yourself staying there, what type of house you're looking at. Are you single, married, children? You need, are you going to be in this school district when you have a child? Are you going to move out?
Yeah.
There's a lot of questions that you could ask up front. And,
absolutely.
When someone's asking you important questions like that, that's a pretty good sign.
Awesome. So that's good. So
I don't want to give out my secrets.
I know, yeah. But this is good. But yeah, so so to summarize that, how to pick a mortgage loan officer, talk to as many people, get some referrals, talk to them, see if you're getting a good connection, see if they're asking you more questions beyond really even just your own numbers and what do you want to put down.
Yeah.
And you can do it, great, here you go.
Yeah.
Ask those additional if they're asking those additional questions, they care more.
Yeah.
And they're going to be a thorough person, which is great. Now let's talk about what you just mentioned a little bit before, 30-year mortgage. Now I know there's a 30-year mortgage option, a 15-year mortgage option. I know there's something.
There's a lot of them.
There's a lot of options.
Yeah.
But let's talk about the main ones and the ARM.
Yes.
Which, I have an ARM now with my home. ARM, adjustable rate mortgage, correct? So you got two options, fixed and adjustable rate mortgage,
correct?
Right? So walk us through what's fixed, which obviously it could be inherent in the name, but give us the breakdown of what's a fixed.
I will. Do want to make one point going back. Don't mean to step back.
That's fine.
But in the process, when you are looking for a person, it's important to limit your search, right? You don't go and talk to 10 people and everyone's running your credit.
Right.
You really want to narrow it down to probably about 3 people. And before you run the credit, let them ask you the questions and kind of feel them out. And then when you're comfortable, give them, because multiple runs of your credit could affect your score down the road, which can in fact affect your rate. So you just want to keep that in mind.
That's a great
point.
point.
Now going back to the types of mortgages that you asked about. So the fixed rate is traditional, 15, 20-year, 10-year, 30-year. They sometimes have 25-year fixed rates, things like that. So that is basically the payments fixed throughout the term of the loan, no matter how much you put down, or basically additional principal payments. It's going to stay the same throughout the term. The ARM loans, which is the adjustable rate loans, which we'll probably see more of those nowadays with the rates increasing because the last 2 years, the fixed rates were so low that they were actually lower than the ARM rates, the adjustable rate mortgages rates.
It was like free money. It was like two something, right? Like two at the lowest.
I think the
COVID.
lowest rate I gave someone on a 30-year fix was 2.375.
Ooh, man, that's wild.
Yeah, it was free money.
That's practically free money. Unreal.
So the ARM rates tend to be lower rates than a 30-year fixed.
Okay.
And when we were talking about that, the reason we went with that was because it was a cheaper rate.
Right.
And it was a cheaper payment. And we went into that knowing that down the road, with us being in a rising rate environment, that eventually when everything calms down, those rates will most likely come back down.
Yeah.
Right? That's the goal.
That's the goal.
So an ARM rate has a period of a 3-1 ARM, a 5-1 ARM, a 7-1 ARM, and a 10-1 ARM. And I think there is one more that we actually have, which is a 15-1 ARM, which a lot of people don't have. So what that means is when you see the 3, 5, 7 in front of that 1, that means that rate is fixed for that period of time. So a 3-1 ARM is fixed for 3 years, and then after that, it can adjust. So short-term ARMs, a lot of people don't do it because it's just too short of a time to let their plans work out.
So,
so the 7 and 10-year ARMs are ones that are more desirable.
Yeah. So let me just dig for a second, just a little bit deeper into what you just said. 3, 5, 7, we'll focus on those. 7, 1 arm. What that means is for, like Matt said, for 3 years or for 5 years or for 7 years, your payment rate, your rate and your payment will not change.
Correct.
It'll be whatever is written at the closing, on the final closing documents, and what you've, spoken about, that we did on the spreadsheets, everything. That is going to be your steady monthly payment until year 3, 5, or 7, depending on the product that you've chosen.
Correct.
Now, let's talk about what happens. Let's say you picked 5-1 arm. So 5 years, everything's going great. You didn't refinance. You're still in that product of the 5-year arm, adjustable rate mortgage. Year 6 hits. What can potentially happen, and what is that rate driven off of?
Okay, so that rate can change. Once it reaches that maturity date, let's just call it, that rate can adjust. That's the whole point of the adjustable rate. So once you reach that term, then the rate could adjust. Lots of times what happens when people get to that point, they're usually either refinancing into a fixed payment, or they're redoing that 5, 7, 3-year term again.
I see.
And the reason that is, when you talk to, say, like a financial advisor and things like that, they tend to like those products because you're paying it at a lesser interest than, say, like a 30-year fixed.
Right.
Okay.
Absolutely.
So you can actually take that money. Let's just say the difference in payments $200 a month.
Right.
A person that's in that arm for 7 years could take that extra $200 every month and say, well, my 30-year payment was going to be X.
Right.
So I'm just going to take that extra money and apply it to my principal for the next years that I have as fixed.
Okay.
So when you get to that point, a lot of people will refinance and restart that term, and it'll actually drop that payment down because now that rate or payment is now based off of the new principal balance, which then reduces your payment. And that's why a lot of financial advisors and planners and things like that like those, because when you have someone that, say, gets big yearly bonuses at the end of the year and they want to drop $10,000 on there every year, when that time comes, they could refinance it, and then when they refinance it, their payment actually drops, where a 30-year fixed, you're putting that 10 grand on there every year, your payment's still going to stay the same. Right. You can always refinance on a 30-year if the rates drop and accomplish that same feat. Right. But if the rates are the same or not as low to redo your 30-year fixed, then it defeats that purpose. So that's why a lot of people like to do it. And that's why, financial planners and stuff think those products are actually, and a lot of times, better than a 30-year fixed.
Right. That's interesting. That's a good point. And the reason why in the 30-year fixed environment, where you're saying the payment does not change, because there's something called an amortization schedule.
Yes.
To your loan. When your loan is created, when you've got your loan and you sign the documents and it begins, you have a beginning balance of the loan. Let's just say that $300,000 loan. If you purchased a $400,000 home and you put down $80,000, it's $320,000 loan is the beginning balance. The moment you set that up, you're going to have a whole amortization schedule or schedule showing your monthly payments, just like you're going to indicate, until 30 years from now, when that $320,000 becomes zero.
Correct.
No matter what you do, short of refinancing, no matter what you do in the in-between during that 30-year period, you can put down $10,000 a year towards that. Now, that would reduce your principal amount, correct?
Yes, but it'll keep the payment the same.
But the payment is going to remain on the amortization schedule that you signed and you saw in your closing.
Correct.
Unless you refinance.
Correct.
If you wanted to refinance, when would you recommend to someone to even consider refinancing?
So in that case, I always like to see the rate actually a full point less.
Okay, interesting.
Yeah, unless it's something you're refinancing for a purpose of taking cash out for a reason.
When you say
or
a point,
shortening your term.
When you say a point, I just want to clarify it for the audience.
1%.
You mean 1%?
Yes. Yeah.
Okay.
Sorry. 1%.
That's okay. Yeah. Just gotta make sure.
Yeah, because that's really where you're going to see the benefit, right? Because when you refinance, you do have closing cost again that you have to factor in. Okay, and in order for that savings to really be a legitimate savings, That's why you want to see that rate move at least 1% down.
Okay. And do you feel like refinancing from an ARM to a fixed, do you feel like it's more like emotional of a thing, like where the people feel like
It's more of a comfort thing.
comfort thing,
Yeah.
right? So when would you recommend to someone, and as someone I'm asking it for myself too, to go from, again, from an ARM, from an adjustable rate mortgage to a fixed? Is it if the 1% basis point, point, as you said, 1% lower, if your rate that you locked in for the 7/1 ARM drops 1% lower than you signed, or is there other considerations to go?
There's other considerations like for instance with an ARM,
Right.
let's just say for instance you have a 4% rate, and the 30-year fixed is 3.5.
Right.
Okay, and you went through your 7-year ARM. Okay, at that point you can refinance for less because you're going out of a ARM to a
Right.
fixed rate, which is a more safer, let's just say, payment structure.
Right.
Okay.
More steady.
Yes, but you still always want to look for that percentage.
Right.
Even coming out of the ARM.
Okay.
But your thought process is a little bit more broadened when you're going from an ARM to a fix. You don't really need to have that full 1% savings, because you're going from an ARM that is a little riskier because you have an adjustment period,
Right.
to a more secured, say 25, 20, or 30-year fixed payment that's more structured and
Right.
never it's going to move, no matter what the rates do.
Yeah. And what recommendation would you have for somebody who likes fixed? Because the reality of it is, right, if you go from 30 to 15-year fixed, it really just means your payments are going to be higher.
Yes, they double.
So do you feel that, when you advise someone, if somebody was to ask you, should I do 15 or 30, is it really just up to them as far as their comfort level, or is there something else that you think that they should consider?
There is a question of do they see themselves staying in the house for the term of the loan?
That's interesting. Okay.
You know what I mean? A lot of people do it to pay it off faster. But a lot of people don't look at it as, if I go into a 15-year fix and I sell my house in 5 years, yes,
Right.
I'll pay a little bit more money down, but I'm also going to double my payment from where it is.
Interesting.
And if I stay on a 30-year or not refinance into a 15 and refinance into a lesser 30-year payment, I can control how much I want to actually put out of my pocket each
Right.
month, because you could still put X amount of dollars down every month towards principal, right?
Makes sense.
So it's a combination of things, and that's where us as the loan officer should ask the question,
Yeah.
and ask the right questions. Why do you want to go to that, and what is your time frame, and additional questions.
So if I was to tell you at the initial meeting that I don't plan on being in a house for the whole 30 years or whatever, I intend to leave it in 7 years. It's really just a kind of somewhat of a temporary home before I find my full home. Would you
Correct.
then recommend a 30-year or 15, or like what would your recommendation be then?
If it's shorter term, you go with a 30.
Yeah.
Right.
Okay, got it.
Now, again, it all comes to the time and the situation,
Right.
Last 2 years, you didn't have to do a 15. A 15, the rate was 1.8,
Yeah.
and a 30 was 2.25, 2.5. The spread is so small at that point.
Yeah, absolutely.
If you're looking at a 15 and it's 1.8, and the 30 years is 4.25 or 3.5. All right, now we're talking about completely different spreads,
Right.
in that interest rate.
Right.
So there's multiple situations of looking at that and making that decision.
Right. Okay, that's great. No, this is
Yeah.
some really good stuff. Let me ask you to I think you mentioned it a couple times while we were chatting, underwriting. Mm-hmm. Now, I've heard that term myself when we were going through the process of, buying my home, underwriting. What exactly does underwriting mean?
So underwriting means once we went through the process and you got into contract and I have all your documentation, and now we're at a point where it's like, okay, we got to submit your loan to underwriting. Underwriter picks up your loan, reviews the documentation that I reviewed to give you the pre-approval, and basically revalidates that
Okay.
and is a second set of eyes where they actually issue an actual written mortgage approval / written mortgage commitment.
Got it.
And that's where underwriting comes in is they're the final eyes before approval and actually before closing to make sure you're meeting all the requirements to get that approval.
Right. Now, a lot of times, and again, from my experience as well, after the second set of eyes gets it and the one that's making the official approval, there's going to be some additional documents that might be requested.
Correct.
There might be some additional things. What, do you find that happens often? What are these potential additional documents that someone should anticipate, possibly being requested to provide, before they get a full mortgage approval?
Yeah. So there's always going to be additional conditions, right? They call it commitment or mortgage commitment conditions, or prior to closing conditions is what they call them.
Right.
So that might just be things where they have to update documents. Like, for instance, if we've been working together and we're going through the process and your closing is a 60-day closing.
Right.
And you give me the pay stubs at the initial process. At some point, those pay stubs are going to expire.
Right.
So then we would have to get updated pay stubs. We may need updated bank statements if you have money that you're transferring from one account to another account,
Okay.
or you're writing, say, a deposit check, and you want to get that credit at closing for that $10,000 or $20,000 deposit you gave.
Right.
We have to show that money coming out of the account as well. That could be a closing addition, homeowners insurance, things like that. So there's always some final stuff that you have to get, and that's really what it is. It's more or less updating of documentation.
Got it. And at the very end, when it's all done, that's when you get the mortgage commitment, correct? So when you've already submitted everything, you've gotten that. I guess sometimes you can get the mortgage commitment, and then there are some additional documents you need before what's known as clear to close.
Correct.
So walk us through that distinction between getting a mortgage commitment and the clear to close.
Okay. So once you get the mortgage commitment, that is the bank committing to giving you that loan.
Okay.
And that's where a lot of the attorneys and the real estate agents need that, because then they can go and say, the buyers got approved, the bank is committing them to give them the mortgage. Here's the proof. Here's the letter.
Right.
And then there's a little bit of a sigh, like,
Yeah.
they're approved.
For sure.
All right, that steps out of the way. And then when you get that, as part of the requirement to close, is where the underwriter will say, all right, go get that homeowner's insurance policy. We have to verify what that premium is for the year. Make sure you still qualify with that payment, right?
Right.
Or if there was something that, let's just say a large deposit, where a client pulled money from a 401k for a down payment,
Right.
they have to see that money. Or in your case, if you remember when you sold the house,
Yep.
we had to show the preliminary closing disclosure
Right.
of how much money you were getting to put down from your
Correct.
sale on the new house.
Correct.
So those are things that come up that they're like kind of like the final stamp of, all right, show me we are good here. I just approved you based on your income and things like that. Get me these few pieces of document that we need updated or whatever. Once
Got
I
it.
get that, we're clear to go. We're good to go.
And when you get so the mortgage commitment, and again, like you said, you kind of like a sigh of relief, because the reason why there's a sigh of relief, and correct me if I'm wrong, is that if there's a clause for the mortgage commitment not going through, and a lot of times deals will fall apart, that's one of the last criteria kind of, you've already gone through the inspections at that point. You've already gone through, all these other criteria. You gave in all your documents. Now it's just that mortgage commitment that's left.
Yes.
If a buyer cannot obtain that, and the bank says, sorry, we can't give that to you. Now the issue is, and why they decided relief is, you can't close.
Yeah.
So either what can happen in that scenario? I mean, is it like a definitive, that's it, you're done, we're not giving it to you, or can you do something else to make that happen?
Possibly. Again, there's so many situations in the mortgage industry. It's
Right.
crazy. But a few, let's say, for instance, the underwriter says, hey, your debt to income ratio is too high because you bought a car during the process, which we didn't know about.
Right.
And now we're at a point where now we have to factor in that payment into your debt to income ratio.
Right.
that may cause you to have to go get someone to help, like a family member that can co-sign for you, which would bring additional income in, or maybe even paying some debt down to offset that payment.
Right.
And then sometimes there's just a situation where you can't get the approval.
Yeah.
But
Yeah.
That not getting the approval is something that you address right from the start, all the way back at pre-approval.
Yep. And
Okay.
that's exactly what we're what we were chatting about before.
Yeah.
When you have a thorough conversation at the pre-approval step, you can more or less gauge within a almost probably sure like 95, 99%. I mean, unless something crazy happens in the meantime, right?
It's hard to give high percentages.
Okay, fine. I won't give you 80%. Can we settle on 80%?
Yeah, it just makes the process a lot of it.
Yeah.
Because what happens is, like, for instance, something that I didn't mention as part of the pre-approval process is once you do the numbers, that's where it's like, okay, don't go out and buy some stuff. Don't go out and buy a car. I've had clients go, oh, I got a lease coming up. I got to get a new car. And that conversation is important because at that point I could say, hey, you're fine. Just make sure your car payment is this and below.
That's
because
great.
we know you have to get a new car if your lease is up.
Right.
They're not going to just wait for you to close on your mortgage to turn your car in.
Right. That's a great point.
And then the other thing too is if you do need a car, then you're having that conversation to make sure you don't do nothing that is going to jeopardize the process. So those are all little things that can be addressed well ahead to avoid that last minute type of situation.
So that's a really good point. And I think we should kind of really highlight that, and I'll make sure to highlight it for you now. If you're going through the mortgage process, you're looking to buy a home, you found your home, you've had the pre-approval process, those things that got settled, that got signed at the pre-approval process time, these things are assuming nothing is going to change.
Correct.
So make sure that as you're continuing to go through the process and be upfront about it. Hey, I'm about to buy a car. Or I'm about to do this. I'm about to open up another credit card.
Yeah.
Don't do those things.
Yeah.
Without at least first talking to the mortgage officer.
Yeah.
Because it's very important, because that can jeopardize, as you said,
It can.
the entire process. And one small thing you might do, let's just say your car payment was $250, you decided to do a little upgrade, without telling anybody, and now your payment is $300 or $350. If it's a debt to income ratio.
Correct.
Is part of the considerations of whether you can afford the loan or not,
And your approval.
Your approval. If that goes up even a tick, maybe like 5 or 10%, or even 2%,
Even less sometimes.
Even less sometimes, it could throw you into this criteria where you've crossed the threshold.
Correct.
And now you do not qualify.
Correct.
So before you do anything of that nature, and you're in the closing process, and you got to do something. If you have to do it, you have to do it. But just talk to the loan officer, be upfront about it, and make sure that it's all addressed so that you can get guidance on the payments or whatever it is. If it's the same payment, you'll probably be okay.
Yeah.
Because it's already been inherently
predetermined. You got to have that conversation. I always tell people, don't feel weird. You know what I mean? Because some people feel guarded or I wouldn't say ashamed, but they don't feel comfortable.
Right.
And they just do it. And that's where, the client does have to, like you said, has to have the trust in you and say, hey, this is what I got to do, or this is what I'm thinking of doing. Is it going to be okay? Because, and again, the spin off to that is it may not affect your income or your debt to income ratio, but it could affect your credit score.
Yeah.
And that could then, in fact, affect your rate, which then could affect your payment, because going from a 720 to a 719 could drop you into another bucket that brings that risk factor higher. Yeah. Which actually, brings your rate higher. So it's a combination of a couple things. But as the client, never feel uncomfortable about asking questions, because that's why we're here. Right. Is to help you through the process to make it smoother for you and release that stress.
Yeah. And realistically, it's all part of what we talked about initially. Picking your loan officer, shopping around, feeling comfortable to tell somebody that without feeling like you're going to get attacked or something, yelled at. Yeah. You know what I mean? And somebody who's going to be a little bit more chill about it and be like, hey, listen, okay, you could do that. And you can, if it's a car lease, you can always extend the car lease, right? For another 6 months or something like that if it happens to literally fall when you're closing. Some things are just, you have to do them. and you have to just be aware of them. But coming clean, telling the mortgage loan officer is super important.
100%.
And I think that is a great points that you brought up. So I want to start kind of wrapping up here. So one of the last things, and we kind of chatted about it, you did mention closing costs, and I think it's super important to touch base because many people don't know exactly closing costs. Yeah, I know what closing costs are. I got to pay to have this loan done.
Yep.
But that's not everything.
No.
So walk through some of the most common closing costs that a buyer or seller, or a buyer in this case, would see at closing that they should be ready for.
So basically, the started off is when you're buying your house. That's a big question. Like, what are my closing costs?
Yeah.
And I do the spreadsheets, as like you said. But one of the things I always tell the clients is when you're out looking, and you're trying to figure out what your closing costs are.
Yeah.
And we haven't talked yet, and you're at the house with the realtor, and you have you love the house, like you feel it's the one. I always tell people, just take the purchase price and do 2.5% to 3% of that purchase price, right? So let's just say it's a $300,000 purchase.
Yep.
3% would be $9,000. So just say my closing costs could be somewhere around $9,000. That way you could just do a quick number in your head, and it's going to make you know, all right, I have this. 9,000 closing costs. All right, I got enough money. Cool.
Got it.
It's something that you could just do real quick off the top of your head. Now, closing costs you'll see are always, here, at least here in New Jersey, you have attorney fees, right?
Right.
You have to pay a fee to your attorney, and then you have title fees. Appraisal fees. Appraisal fees is like when they go do the appraisal, the bank will send an appraiser out there to make sure the house is meeting the collateral of the purchase price,
Right.
Or the value of the purchase price. You'll have your credit report fees. The banks always have a fee, like an application fee or a commitment fee.
Right.
They have many different terms to it, but normally they're the application, commitment, underwriting fee. They're usually all around the same. They all usually mean the same thing. And then you have like recording fees. There's a lot of them. There's a lot of them, and they add up.
So you would say, again, on a conservative basis, 3%.
Correct.
Of the purchase price.
Yeah.
You should anticipate to have the closing fee. So this is important for the listeners who might have maybe a tighter a bank balance, tighter cash amounts in their bank accounts. And they thinking, your initial thought is, 20% down. I know that. On a $400,000 purchase, that's $80,000. And sometimes you don't realize how much the closing costs might play into it. So in the example that you just gave, Matt, which was a great example, is, in a $400,000, your 3% would be $12,000.
Yep.
So if you were to put $80,000 down and $12,000 of closing costs, now that's $92,000.
Correct.
That you got to be ready to part ways with for the whole thing together.
And that's a quick math you could do in your head.
And that's a quick math you can, and that's like a rough idea because there's going to be a lot of closing costs and a lot of things. And there's the closing disclosures that the mortgage loan officer will provide you that reflects reflects the loan estimate, reflects all those little costs that you're going to have. But again, as you said, when you're looking at this dream house of yours that you really want, you're not going to sit there and go, let me see that closing. You want to have a rough idea of what cash outlay you're going to have at closing.
Correct.
So that's a fantastic point. And as you said, and I do want to kind of touch on that a little bit, appraisal is also part of that closing process of the house purchasing process. And what an appraisal is, as you mentioned to it, is someone coming out, looking at the house, going over it, comparing it to other homes to ensure to the bank that should, God forbid, anything happens and you need to sell this house or you need to foreclose on it.
Correct.
You're going to be able to get back at least the mortgage that the bank is owed.
Correct.
Is that correct?
Yeah.
Okay.
Yeah. So it puts a value on the comparables in the area that are comparable to that house and gives the bank, like you said, that number of what that house is currently worth.
So there's a lot of comfort going around. You want to be comfortable. You can afford the payments. The bank wants to be comfortable that they can obtain back their loan should there be any issues with payment, default, so on and so forth. And, they can always obviously work around that as well. If God forbid somebody's having a tough time, they can also get in touch with the bank before the foreclosure process as well,
Correct.
and
Correct.
and renegotiate terms, extend terms,
Mm-hmm.
figure out a better payment, even if it means you extend the years or whatever it be.
Mm-hmm.
You work with the bank before you just stop paying altogether,
Yeah.
which is also important.
And that you could always, I always tell my clients, you could always call me.
Yeah,
If there's any question even after the process. I always tell the client that the process doesn't end. Our relationship doesn't end at the closing. Like, it's always there. And
That's
a
great.
lot of people forget that.
Yeah.
And and that's part of when you're narrowing down your search for a loan officer, is that you're looking for someone that is going to be there,
Yep.
not just during the process.
Yep.
And a lot of times when you're finding banks that are online and stuff, it's just kind of like you're a number,
Right.
and
Absolutely.
and that's important too.
And I think that again is why we're having this conversation
Yep.
now, why we touch base, even though the transaction was done in the end of June, and we said, you're saying congratulations, thank you and everything. We parted ways, but we're still kept in touch. I'm still referring you. I'm still talking to you. And here you are adding a ton of value to the listeners, to everybody. So thank you for coming on the show.
Oh, I appreciate
that. Thank you for
having me.
being part of episode 1,
Yes.
man. I love it.
Awesome.
And, if the people want to get in touch with you, if they want to reach out to you, find you, talk to you, ask you a question, how will they get in touch with you?
So they could actually find me online if they search my name.
Awesome.
They could find me on Zillow. They could find me in a Google search, and they could actually look me up. You could say, just type in a Google search, Matt.schofield, NJ Lenders, and I'll come up. You can find out that way. And then you could actually also call me as well. I don't know what I'm allowed to give you online, but
Yeah, whatever you feel comfortable with,
yeah.
if you want to give it. But, why don't you just spell the name out? Obviously, Matt,
Yeah.
and then the last name, just spell it out for the listeners
it's
so that they can easily
it's
find you.
SCHOFIELD.
Awesome.
And you could actually also email me at schofield@njlenders.com.
Awesome. You're going to get some great service if you do this. Matt, thank you so much for coming on
Thank
the
you
show.
for having me. I
appreciate
really
that.
appreciate it.
It was really great.
Thank you so much.
Yeah, you
It
got
was
it.
a
All
pleasure.
right.